Hello, savvy investors. Welcome to this brief yet hopefully clear guide on how US retail folks like you can tap into emerging markets, those buzzing economies full of growth potential, but also a dash of drama. Think of EM as the spicy side dish to your US stock burger. Remember, I'm not here to advise or make recommendations. I'm just your friendly educator to unpack options like mutual funds, active and passive ETFs, ADRs, and even direct foreign stocks through the right brokerage. This is for informational purposes only, no advice. Always DYOR, do your own research, or chat with a pro, as investing risks include losing principal, currency wild rides, and political surprises that could make your portfolio do the cha-cha. As of December 2025, let's unpack the full framework from structural shifts to brokerage nitty-gritty. Hopefully this will be a fun and enlightening exercise. Picture this. The world's economy is decoupling in an unexpected way. Emerging nations are booming economically, but developed ones like the US hog the market cap spotlight. For you, a US retail investor, it's a head scratcher. If you do research, many would say you should allocate 5 to 15% of your portfolio in EM. After many years of underperformance, EM may scream to you, invest me. As we have talked about in a previous video, many people are already pivoting to EM. If you have not seen the video, please check out the link in the description. Here's a quick overview of why some are investing in EM now. Firstly, US dollar might be cyclically weakening. History shows dollar slumps often mean EM shines as capital chases growth. EM seems to be re-accelerating in growth with improved fundamentals and quality of the local companies and economies. Finally, diversification a la modern portfolio theory. EM doesn't move in lockstep with US stocks. Think commodity booms in Brazil or shopping sprees in India. They can tame your portfolio's wild swings and add shock absorbers to your wild investment vehicle. Then, the efficiency gap. US markets are super efficient. It's tough for managers to beat the S&P 500. But EM, information asymmetries, less analyst love, and more retail frenzy make up a perfect recipe for active managers to snag pricing gems passive funds ignore. But actually getting into EM, it's like navigating a labyrinth with custodial headaches, complicated regulations, and market quirks. This guide is your map, an exhaustive breakdown of access points, mutual funds, ETFs, ADRs, and direct market access, plus brokerages to make it happen. Option 1, mutual funds, the classic ride for international vibes. But before we talk about mutual funds, we need to have one quick clarification. Indexing, aka index funds, are a strategy, not a structure. It's about tracking benchmarks like MSCI EM, not beating them. This can be done in passive mutual funds or passive ETFs. Same guts, different wrappers. Index mutual funds offer a better systematic investment planning, while ETFs offer intraday trading and better tax efficiency. However, the overall strategy is identical. The main differentiation among the index strategies is then the benchmarks the index funds track. Many passive ETFs in particular track different subsets of the main EM benchmark. And we'll talk about it later. Back to mutual funds. Since we talked about passive mutual funds, aka index funds, let's talk about active mutual funds. These are open-end funds that pool money managed by pros and priced daily at NAV. Investing in a mutual fund for a retail investor encourages the hold tight discipline, not the day trading frenzy. Why would one buy a mutual fund? First, potential for alpha, especially in inefficient EM. Skilled managers can exploit pricing anomalies. Active ETFs also seek alpha but may not have as much flexibility. Second, access to illiquid or niche opportunities like small cap, frontier, illiquid, IPO, or private securities. Such access and flexibility are often challenges to active ETFs. Third, cash holdings. Mutual funds can increase cash holdings for downside protection during market downturns. Again, This is often limited for active ETFs. Finally, establish track records and limited capacity. Many of these mutual funds have been around for longer, helping us to evaluate manager skills over cycles. Also, top funds may close and stop taking new investments, whereas ETFs cannot close. Mutual funds would do this in order to protect their performance, as the larger the fund size, the harder it is for them to outperform. This can be significant in a space like EM, where capacity is fairly constrained. Why would one not buy a mutual fund? This is where the cost reality bites. Mutual funds often charge higher fees to retail investors with expense ratios at around 80 basis points to 150 basis points. There are also tax inefficiencies. And lastly, despite the information available, it is still very hard to evaluate and find good fund managers. Here are top 5 largest or most well-known active mutual funds available to the retail investors. Access to these funds is pretty easy via any of the big brokerages like Schwab and Fidelity. A few things to highlight here. First, let's look at the performance numbers, since these are active funds trying to outperform the index. The MSCI EM benchmark figures are on the top in blue. As you can see, the 5 largest funds' numbers vary both against the benchmark and against each other. Some argue that a few of these funds have gotten too big, which make them hard to outperform, so we can find better numbers in smaller peers. One highlight is Lazard's 5-year number. They have definitely benefited from the extreme outperformance of the value stocks over the last few years. Another thing to note is American Fund's New World Fund holds many stocks in the US, such as Broadcom, Microsoft, and Nvidia. They argue that they are simply capturing the growth in emerging markets through holding these stocks that have businesses in emerging markets. You be the judge. Finally, about the costs. You can see that the expense ratios are high between 87 basis points and 128 basis points. But also, don't overlook the fees and loads for buying and selling these stocks. The front load fee is what the brokerage charges you for selling you the mutual fund. If you invest $10,000, you have to pay more than $500 for the American funds and Invesco funds. However, your broker may offer you a discount, so make sure to check that. Here are a few prominent passive index mutual funds. Remember, index funds are a strategy, not a structure. The top 2 funds track MSCI EM benchmark, which is the main benchmark used for active funds. Vanguard is using FTSE benchmark, which regards Korea as a developed country, and Schwab uses Russell-Rafi, which has a value tilt. As you'd expect, these funds have lower expense ratios and track the performance of their benchmarks fairly closely. Again, one benefit of buying these index funds over passive ETFs is that you can set up automated investment plans more effectively. Enter ETFs, the dominant retail vehicle. Trade like stocks. Revolutionize EM access with low costs. Passive ETFs track indices like MSCI or FTSE EM. Allow broad exposure to thousands of stocks for 8 basis points to 11 basis points. Buy the haystack and ditch single stock or manager risks. Within the passive, there has been a new trend. Smart beta, and EM is not an exception. On the active side, active ETFs grew double the amount of passive in 2024 and 2025. These are like active mutual funds, but with the ETF structure offering lower fees, but perhaps less flexibility for the managers. Here is a table that compares the 3 types. Passive ETFs are straightforward for you to understand. Smart beta ETFs would follow certain factors like value, growth, or momentum. It is passive in that it is quant rules based and sits somewhat in between straight up passive index funds and active funds. Active ETFs are very similar to active mutual funds we talked about earlier. Professional managers select stocks for these funds, so the fees are higher but still lower than the active mutual funds. Here are the top ETFs by size and breadth. One outlier here is the first one, iShares EM ETF called EEM. Its fee is high at 72 basis points. The next 3 have slightly different benchmarks that they follow. The last one is one that's gotten more attention in recent years. It's the EMX China ETF for those who do not want to own China. You can see the differences in performances based on what exactly they track. Now to the other passive strategy, smart beta. Again, these try to follow certain factors. The first one tries to invest in large cap stocks. iShares EEMV is focused on lower volatility stocks, WisdomTree's DEM on high dividend yielding stocks, and Goldman Sachs GEM on its own combination of four factors. The expense ratios are higher now, and the performance differentials are noticeable as these funds target specific styles. By the way, the top two numbers in blue are the traditional MSCI EM index numbers. Moving on to a few active ETFs in EM. One interesting thing to note is that the bid-ask spread, which is basically the trading cost, is a bit high. The assumption is that these ETFs are not very liquid, so you need to pay up to buy or sell. This space is hot, but there are not as many ETFs with long track records. JP Morgan's JEMA and Dimensional's DFAE have not yet reached 5 years in life. For hands-on investors, you can buy individual stocks via ADRs. ADRs are U.S. certificates for foreign shares, issued by banks like the Bank of New York Mellon. How does it work? A U.S. bank holds local shares abroad. You trade ADRs in U.S. dollars on New York Stock Exchange or NASDAQ. Dividends? Converted into U.S. dollars minus tiny fee. These ADRs provide a great way for U.S. retail investors to build a portfolio with EM blue chips like TSMC in Taiwan, HDFC Bank in India, Vale in Brazil. You can use a standard brokerage. The U.S. listing ensures a better governance, especially from weak rule countries. The limitation is that only the large caps have ADRs offered. Many small and mid-cap companies rarely have these due to costs. Liquidity can also be thin, especially when home markets closed, leading to wider spreads than the local shares. Here are some main ADRs you can buy today. China has the most ADRs listed, and many are household names with huge liquidity. Taiwan has more than just TSMC, as you can see. For India, ADRs provide a great access to an otherwise very difficult market to invest in. Brazil has both commodities and high growth names. Korea offers a variety as well, with a notable absence of Samsung Electronics. It does trade in Europe, so if you have access there, you can consider. There is an expectation in the market that SK hynix may list an ADR in the near future. Here are a few other names to consider. For purists, DMA, buy direct on home exchanges like Shanghai or Bombay. It's a purist play, but also a friction galore with FX costs, time zones, and tax mazes. Here are some country quirks. India is a fortress. Both non-resident Indians and non-Indians need to go through a complex process. China can be a minefield. Remember, there are H shares that are traded in Hong Kong and A shares that are traded in Shanghai and Shenzhen. You can buy A shares via Stock Connect through Hong Kong, so this part has gotten easier in recent years. But US sanctions on a variety of strategic sectors risk-blocked trades and frozen assets. In Brazil, you need a CPF tax ID and a local representative, which can be your broker. Speaking of brokers, here are some brokers you can use to trade directly. Interactive Brokers is the pros pick. It offers access to 160 markets and 37 countries, including many of the EM countries listed on the screen. Fidelity offers a much more limited access, but offers an integrated platform for your other investments there. For Charles Schwab, you can create a global account for access to a handful of EM markets. It also has a 24/5 global desk, but definitely has a smaller reach than Interactive Brokers. There you go, folks. We went over the 4 main ways to invest in EM. Remember, this is information and education only, not advice or recommendation to buy or sell. EM investing comes with risk of loss of principal, FX, and politics. Remember to DYOR, do your own research. Thanks for watching. Remember to like and subscribe.